Consider two individuals. Both invest $1,000, earning 7% annually. One begins at age 25, the other at 35. At age 65, the person who started earlier possesses over $149,000, a significant sum from early action. The one who began 10 years later has just $75,000. This is a substantial difference, highlighting the cost of delay. A 10-year delay costs $74,000. This difference is not due to superior stock picking or market timing. It is simple mathematics. This principle, often overlooked, is the silent engine of true wealth accumulation. It reveals how quickly capital multiplies over time. Today, we demystify this powerful engine, the Rule of 72, a simple key to understanding your financial future and accelerating growth. The financial world offers many complex formulas, yet one simple principle provides clarity on investment growth. The Rule of 72. This rule, understood by those who build generational wealth, predicts the approximate time it takes for an investment to double in value. It cuts through the noise of market speculation, offering direct insight into the enduring and powerful nature of compounding returns. Banks and financial institutions rarely highlight this rule. Its elegance simplifies what they often make intentionally opaque for their clients. This knowledge empowers the individual, providing a clear compass in a complex financial landscape, fostering independent decision-making. The Rule of 72 states, divide 72 by your annual rate of return. This simple calculation yields a powerful insight. The result is the number of years required for your capital to double. It's a simple, yet powerful calculation for investors. For instance, if an investment yields 6% per year, 72 divided by 6 equals 12. Your money doubles in 12 years. At an 8% annual return, your capital doubles in precisely 9 years. 72 divided by 8 is 9, a clear demonstration. This is not an exact scientific law, but a highly accurate approximation for typical investment rates between 6 and 10%. This simple formula allows you to quickly assess the potential of any investment without needing complex software or advanced tools. Its value lies in its predictive power and ease of mental calculation. It demystifies the often intimidating concept of exponential growth. Let us visualize this with an initial capital of $10,000. Consider 3 distinct annual growth rates to see the difference. At 7%, your $10,000 becomes $20,000 in 10.3 years. This marks the first doubling period. It then doubles again to $40,000 in 20.6 years. The profound power of time in the market is evident. It reaches $80,000 in 30.9 years, then $160,000 in 41.2 years, accelerating significantly. This impressive growth is achieved after just 4 doublings, a clear testament to consistent returns and the power of compounding. Now, at 10%, that $10,000 doubles to $20,000 in just 7.2 years, a faster pace. It then becomes $40,000 in 14.4 years. Notice the accelerated timeline compared to the previous example. $80,000 is reached in 21.6 years, $160,000 in 28.8 years, showing rapid growth. Again, this is after 4 doublings. The higher rate significantly reduces the time required to reach the same financial milestones. Finally, consider 12%. Your capital doubles to $20,000 in a remarkably short period of just 6 years. It then reaches $40,000 in 12 years. This rate offers notable speed and efficiency in wealth accumulation. $80,000 is achieved in 18 years and $160,000 in 24 years. The same 4 doublings, much faster. The difference in the time required for the same capital growth is stark. A higher rate accelerates the doubling effect dramatically. The exponential impact of even small rate differences becomes profoundly clear over extended periods, leading to significant wealth creation. A small increment in your rate of return does not merely add wealth, it multiplies it at an accelerating and powerful pace. This is the essence of compounding. Capital works for you, and its output increases with its own output in a virtuous cycle. Many people understand compounding intellectually, Few appreciate its practical, time-sensitive implications for their own financial future. The earlier you begin, the more doubling periods your capital experiences. This is where true and lasting financial advantage is forged. Consider an investment of $500 per month at an 8% annual return. You begin this journey at age 25. By age 65, after 40 years of consistent contributions, you would accumulate over $1.6 million. Now delay that same monthly contribution by 10 years, starting at age 35 instead of 25. Observe the stark difference. By age 65, with only 30 years of contributions, your total would be $730,000. That is the profound cost of 10 years. A reduction of nearly $900,000, simply due to lost compounding opportunities. The initial years of compounding are the least dramatic in absolute terms, but the most crucial for future exponential growth. This is why the young have the greatest asset, time. It is a finite resource that, once spent, cannot be replenished. The wealthy understand this implicitly. They prioritize capital deployment early and consistently, maximizing the power of time. Every year of delay represents a significant opportunity cost, a compounding period forever lost and impossible to regain. Albert Einstein reputedly called compound interest the eighth wonder of the world. He understood its profound implications for wealth. It is not merely a financial concept. It is a reflection of patience, discipline, and a long-term perspective on true value. The man who consistently understands and applies this principle possesses an inherent and significant advantage in the market. This wisdom transcends mere financial gain. It speaks to the power of small, consistent actions over extended periods of time. It teaches that significant outcomes often arise from understated, persistent effort rather than sudden, dramatic shifts or gambles. This long-term perspective is not merely about personal gain, but about building a lasting and meaningful financial legacy for generations. The question then becomes, where does one find consistent 7 to 12% annual returns without undue speculation or excessive risk? Historically, broad market index funds, tracking the S&P 500, have offered average returns within this desirable range. These instruments provide diversification and mitigate individual company risk, requiring minimal active management from the investor. Real assets, such as well-selected income-generating real estate, can also provide robust growth and consistent cash flow over time. However, real estate demands more involvement, management, and carries illiquidity risk. It is not for every portfolio or investor. For the sophisticated investor, private equity or direct business ownership offers higher potential, alongside increased risk and complexity. One must seek underlying value and cash flow, not speculative appreciation or ephemeral market trends that quickly fade. Thorough due diligence is paramount. Understand precisely what you own and, crucially, why you own it for the long term. Avoid entities promising rapid, unrealistic returns. They often obscure substantial risk with complex language and unverified claims. My grandfather always said, "If it sounds too good to be true, it is probably designed to separate you from your capital." A consistent, moderate return, compounded over decades, builds far more enduring wealth than any fleeting high-risk gamble. The objective is not to become rich quickly. It is to become rich inevitably, through disciplined capital deployment and patience. While past performance does not guarantee future results, the mathematical principle of compounding remains constant and unwavering. We don't fully know what global markets will yield in the next decade, but the mechanism of doubling will always persist. The greatest challenge to harnessing compounding is not understanding the math. It is mastering one's own human psychology. The human mind seeks immediate rewards. Compounding offers delayed gratification, often over decades, requiring significant patience. This requires resisting the urge to chase short-term gains or react to every market fluctuation with emotion. The market will always present opportunities for excitement and fear. A disciplined investor observes, then acts rationally and calmly. My family always emphasized that wealth is built not by what you do during market frenzies, but by what you do consistently. This quiet resolve, this unwavering belief in the long term, is the true engine of sustained financial growth and security. Cultivating patience and emotional detachment from daily market swings is a crucial skill for all serious investors. The mathematics of wealth are impartial. They do not care for your intentions or your hopes. They respond only to your actions. Understanding the Rule of 72 is not enough. It must inform your decisions regarding saving and long-term investment. Prioritize starting early. Prioritize consistent contributions. Prioritize reasonable, diversified returns over speculative hype. The path to financial security is rarely dramatic. It is often a quiet accumulation, a steady unfolding of capital over time. Wealth whispers. It does not shout. And its most potent tool is the relentless, silent power of compounding returns. Your capital, properly deployed, will double and redouble. It simply requires time and your unwavering discipline and commitment. This is the quiet truth. A simple rule, applied with unwavering consistency, transforms modest beginnings into substantial ends. Consider this principle not as a trick, but as a foundational law of financial gravity. Ignore it at your own peril. Begin today. The most powerful financial tool you possess is time. Combined with this simple, profound rule, this is the quiet wealth. If this changed how you see your money, subscribe. New clarity every week.